Thank you very much. Thank you for inviting me to this conference. First of all, I would like to reply a little bit on my role as a CFO and CRO. To my opinion, these two roles should communicate a lot and exchange a lot, so it's easy because I talk to myself. Okay. So I'm really delighted here to stand in front of you at the second XPRIMS conference, ESG, in the insurance industry. And those of you who have participated also last year, I would like to remind that I started my presentation with the Global Risk Report and the most important risks that wait for us in the next 2 to 10 years. And I would like to start now with the 10 biggest risks of this year's Global Risk Report. And as you can see here, not much has changed. So the biggest risks are the environmental risks still. And this means that for especially for us as insurance company, that climate risks and their effects will continue to be really a particular focus of our industry. And this is especially true for European insurance groups like Vienna insurance groups, because Europe is the continent that is warming the fastest. Over the last 4 decades, warming has been twice as fast as the global average in our region. Now, especially weather events, including hail, storms, flooding, droughts, play a particular important role in our region. And regarding the VIG NatCat losses, they amounted to 160 million euros in 2023, which was around 50% higher than in 2022. And already Ms. Hilkemer has mentioned that the insurance industry cannot cover the increasing losses on its own. It's simply not possible. And that is also why we see an increasing discussion about cooperative partnerships with the state and the introduction of catastrophe insurance as an important instrument for mitigating economic losses following these extreme climate-related events. But in our view, it's also very important to consider raising public awareness of the risks of natural disasters, and on the one hand, how to insure against them, but also as well as taking preventive measures. Petra Hilkemer also pointed out in her speech that EIOPA has found out the reason, due to a study, for the lack of willingness to insure against natural disasters. It is merely because people believe that the government or the society as a whole will step in financially if this happens, and the state will step into a far greater extent than it is actually the case. This is also in line with the findings of VIG, of a study that we conducted last year with the Gallup Institute on risk literacy. We believe that strengthening risk literacy for the population is a key task, and I will discuss about this a little bit later. But now the main question is how we can get this ESG topic on track. Environmental activities have long been part of the sustainability strategies of the insurance industry, and they also play an important role in the new mandatory reporting requirements that insurance companies have to implement in this context called ESRS. I would like to focus on this first, especially on the new Corporate Sustainability Due Diligence Directive, quite a complicated name, which was finally adopted after a long political battle in mid-March this year. The most contested element of this EU directive is the so-called transition plan, which you can see here on the left-hand side of the chart. Now, what is the purpose of these plans? In simple words, each insurance company must identify a carbon footprint of both sides of its balance sheet, the asset side and the liability side. What are our financed and what are our insured emissions, and what emissions are caused by our office building, our own operations, vehicle fleet, and also business travels. And this carbon footprint, from a reference year to be chosen individually by each company, shall be reduced by 90% till 2050. This is the so-called transition to net zero. It is important to underline that this transition plan should be developed from a strategic business perspective. Now, which assets do we want to shift, and which corporate customers do we want to attract? Compliance with our own plans will be supervised by our national regulators. This is particularly important when it comes to the setting of the intermediate targets from today until 2050. Intermediate targets must be reasonable and timely. In case we would postpone everything into the future, this would be called time washing, so we really have to start now. And in case you claim to be net zero, but don't adopt reasonable measures or steps and programs to reach this target, this would result in greenwashing, which is a serious risk and has serious consequences on the reputational risk of companies, not only for stock-listed companies, but all insurance companies. And you all know in the media, they have some companies has already been fined for this, so this is a real big risk. So in this relation, it also seems logical that the variable remuneration of the executive board should be linked to the KPI results associated with this strategic transition plan here on the left-hand side. On the right-hand side of the chart, you can see that the Solvency II review also introduces the regular requirement for a prudential transitional plan. So this transitional plan takes a different view, namely the different perspective. It looks at the risks pure from a risk perspective, or the environmental risk pure from a risk perspective. So what does the decarbonization path fixed in the transition plan practically mean for the insurance group? Which financial consequences does it have? In our view, this perspective is best placed in our ORSA, which has already been mentioned by Petra Hilkemer in her speech, where we as insurers deeply dive into our own risk landscape and we perform scenario testing. And here I would also like to underline that risk should not be only understood in one direction as a downside risk, it should also be understood as upside risk. When we use the term risk, we usually think of the negative events. What can go wrong? What is the probable maximum loss? But there is also an upside risk, an opportunity that can bring good business and returns. Therefore, the prudential transition plan will reflect on both sides of the risk, on the upside risk, but also on the downside risk. And in ESG risk perspective, looking only on the downside risk would be incomplete. So we also have to look on the opportunities. Let me give some examples here. For example, the measures and the strategic importance of reducing emissions will also orientate the business model, including skills, products, strategies towards the future. Our customers and NVST companies that improve the ESG risk profile automatically will also improve our risk profile and help us fulfilling our transition to net zero by 2050. So in my view, the transition plan should be seen as an opportunity to get the ESG issue on track and to support companies in remaining fit for the future. Now let me also give you an overview of our portfolio and green bonds. We have established clear criteria as part of our sustainability program in order to achieve the group's goal of reducing greenhouse gas emissions from the investment portfolio and the corporate and retail underwriting portfolio to net zero by 2050. Measures such as the application of exclusion criteria and an increase in the proportion of green investments serve this purpose in investment and underwriting. And here you can see how far we already increased our investments. And let me add, we would really love to do more, need more, also there should be more on the market to invest in. Now, as VIG, we also consciously pursue an engagement approach. The next slide, please. I also see this approach as a positive instrument to support companies to improve their ESG profile. As I mentioned earlier, of the upside risks. We have the path of dialogue rather than the fundamental exclusion of companies from investments in order to achieve the ESG goals. This applies to companies that have not launched insufficient initiatives yet to reduce emissions or have only a low ESG rating now. So in the cooperation with ISS, ESG, here also is a great advantage. So that they intervene not only in the interest of VIG, but also for many investors regarding ESG engagement. So with this, we also increase the risk awareness and the interest of the analyzed company to improve the sustainability measures. So for us, excluding companies in principle due to inadequate sustainability criteria takes really away the opportunity to support and help shape their sustainability endeavors. We therefore see this engagement approach as an important instrument for supporting our and the EU's joint climate neutrality goals. And this is especially true for the region where we operate in. Finally, I would like to return to the point I have made at the beginning about raising public awareness of risks. To achieve sustainability goals, we need a shared commitment, a shared understanding and awareness on the part of all interest groups involved, including the public. So people will only act and protect themselves against risks when they are aware of them. The fact is that people only deal with the everyday risks to a limited extent, and that this results in a lack of risk awareness. But if something happens, the state should step in financially. There are clear deficits in risk competence and widespread misconceptions regarding financial protection by the state. These are the results of a representative study which we conducted with the Gallup Institute on behalf of VIG last year. We asked 9,000 people aged 18 and over in 9 of our countries about their perception of risks relating to health, loss of labor, self-inflicted accidents, household risks, and internet fraud. Now, 2/3 of the respondents were little or not aware of all these risks, while 70% did not believe that they would materialize. However, if one of the risks materializes, the financial losses are estimated to be quite high. Most respondents hope for luck and prevention along the lines of, I will take care and nothing will happen to me. If a risk occurs, the majority of respondents assume that losses will be at least partially covered by the state or the society as a whole. The greater the expected damage, the greater the expectation that the costs will be borne by the state or society. On the other hand, there is a high level of realization that too little is known about the topic of risks and its consequences. More than 1 in 2 would like to get more information and advice from competent experts. So at Vienna Insurance Group, we are building on the results of this study. And this forms the basis for us to implement targeted activities together with the group companies in the upcoming years to increase the risk awareness in the countries. This is because we have defined risk literacy among the population as a key focus of our social sustainability goals. Some of our group companies have already started with activities. For example, the Austrian Wiener Städtische, our largest insurance company, uses target information campaigns to address women and students about relevant everyday risks and individual prevention needs. We have school projects in Romania, for example. We have launched podcasts in Slovakia. There are financial courses on Facebook performed or done in the Baltics. So this topic is really an integral part and foundation of our business model. After all, assuming long-term responsibility and thinking in terms of generations are core aspects of insurance. This requires an intact social and ecological environment. And this should be in the interests of all companies, as it is the only way we can be successful economically or otherwise. Thank you.